interest rates have been making news headlines for months now, with investors and homeowners keeping a close eye on what the banks are doing. And while long-term interest remains higher than in the past, short-term interest rates dropped almost half a percentage point last week. Here to explain what that means is Peter Cishecki with Everything Financial. Peter, good morning.
Good morning.
So why is that drop happening?
Basically, it's because the banks see what's going to happen with interest rates down the road. They know in the next 4, 6, 8 months, our crystal ball might tell us one day, but that interest rates are coming down with that large drop in inflation that we had last month, which was significant. That's kind of a sign of where interest rates are going.
Okay, so now is that specifically to short term or long term?
It was just short term. The 3 to 5 year rates are still lower than the short 1 and 2 year rates, but way higher than they used to be. But now those short term rates are getting closer, and that's what you have to look at if you're getting a mortgage or doing a renewal. Do you lock in or do you just go short term?
Okay, so what is short term versus long term, just for those who don't know?
1 year at just a little over 5%, and the longer terms are in the 4%, 4.5%. It varies obviously with every lender. But what you need to look at is the cost, because if you compare a rate, don't think over the next 10, 20, 25 years. Look at what that interest cost is really only over the next 12 months. And even though the rate might look like it's still a significant difference, dollar-wise, there's very little difference. So don't get stuck in the long term and then realize in 2 years from now, holy cow, interest rates are 2% lower, and I have a $20,000 fee if I want to change.
Right, that's where they ding you. So you're thinking that people should look at those short term?
Absolutely, absolutely. And the questions you need to ask and calculate and talk to someone on are, what is the real cost difference in what I'm spending in interest? But more importantly, if I go longer, how bad is that penalty? Because in years 3, 4, and 5, you're going to really overpay based on what we're seeing.
So do you have the option of fixed versus variable with those?
You do, but problem is with variable right now, because of the interest rates, there used to be large discounts on variable, prime minus 1.5, prime minus 1.25. In these high interest rate times, that discount has gone away. So variable will be better again eventually. It's just not very good right now.
So you think people should consider fixed then?
I'd go fixed, but I would definitely go with the 1 year. You bite the bullet. It doesn't look as good. You tread water a little bit, but the actual cost out of your pocket, the difference is not that significant.
Would you ever tell someone to lock in now? Would now be a good time to lock in? I mean, what are people telling you when they come to you for advice?
I wouldn't tell them to lock in right now. People get fearful. They see the news. They see what's going on in the States where interest rates are different than here. They're calculated differently. They're done differently because they don't have the variable climate we do. So they have to raise them a little higher. And they think, oh my gosh, people actually thought interest rates went up last week because the U.S. had a 1/4 point bump, where ours actually went down a 1/2 point. So they need to watch more of CTV to realize what's going on in Canada.
And the segment in particular, of course.
I didn't say that. You did.
But I love how you kind of set it up there, absolutely. What else should people be considering, though, if they are looking at renewing or getting a mortgage?
If they're looking at renewing, look at really the shortest term you can. Sometimes even look at, maybe on a renewal for sure, extending your amortization a little longer for now, especially with the cost of living right now, and inflation has gone down, but it's still 5.2%. So maybe you have to extend your amortization from 15 years to 22 years to keep your payment in line with what's comfortable for your family. Because the more important thing is not paying off your house right now. It's putting gas in the car and feeding the kids.
Food on the table, for sure, absolutely. Peter Cishecki, you always put into perspective for us. Thanks for joining us this morning.
Thanks a lot.
Okay.